The fluorescent lights inside a Walmart in Dayton, Ohio hum past midnight. A woman in blue medical scrubs stands frozen at the self-checkout screen. The machine flashes a single sentence. Payment declined. She tries another card. Declined. Then another. Declined. America, the richest country in modern history, is quietly running out of breathing room. By 2026, American household debt climbs beyond $18 trillion. Credit card balances hit historic highs. Auto loans stretch across 7-year terms. Student debt shapes entire life decisions before adulthood even begins. Millions of families are no longer borrowing to build wealth. They are borrowing to survive. And yet, the modern American economy depends on this behavior. Consumer spending drives nearly 70% of U.S. GDP. Every swipe of a credit card keeps the machine alive. Debt is no longer simply a financial product. It is infrastructure, which creates a disturbing paradox. How does a nation become structurally dependent on its citizens owing money? To understand this, you have to go back to a very different country. A country where debt is feared, savings are celebrated, and borrowing money carries social shame. This is America post-World War II. Factories that once produced tanks now manufacture refrigerators and washing machines. American industry dominates the planet. Wages rise alongside productivity. A single income can purchase a suburban home, raise children, and maintain savings. Debt is viewed not as leverage, but as danger. The Great Depression still lingers in cultural memory like a scar. How do you convince a cautious population to spend tomorrow's income today? The first major answer arrives through suburbanization. The 30-year mortgage becomes normalized. Instead of saving for decades, families can spread payments across time. Then comes the automobile boom. Americans stop asking, "Can I afford this?" and start asking, "Can I afford the payment?" The real transformation begins in 1958. Bank of America launches the Bank AmeriCard, mailing 60,000 cards directly to residents. Consumers spend significantly more money when using credit instead of cash. Cash feels finite. Credit feels abstract. Unlike mortgages, revolving credit never has to end. Banks realize they are no longer merely lending money. They are monetizing human psychology. By the 1970s, oil shocks drive prices upward. Wages struggle to keep pace. Debt changes from optional enhancement to economic necessity. Borrowing to buy groceries simply transfers future income into the present. The system begins replacing rising incomes with rising credit access. Then comes the Marquette National Bank decision in 1978. Interest rate caps effectively collapse nationwide. Credit card APRs explode upward. Lenders no longer need borrowers to succeed long term. They only need continuous loan origination. This changes incentives across the financial ecosystem. Income growth slows for large sections of the population. Debt growth accelerates instead. Median wage growth weakens relative to living costs. Student debt explodes. By 2026, total student debt surpasses $1.7 trillion. An entire generation enters adulthood already financially constrained. Technology supercharges everything. Algorithms discover a brutal truth. Financial stress itself can be monetized. The healthiest borrower is often the least profitable. So the system evolves toward maximizing long-term indebtedness rather than independence. In 2008, the housing bubble bursts. Millions lose homes. But the crisis reveals the country cannot function without massive consumer borrowing. The machine requires flow, and debt is the flow. Our economy isn't just supported by debt, it's built on the necessity of never paying it back. After the 2008 financial crisis, the Federal Reserve pushes interest rates toward historic lows. Officially, the goal is stabilization. Cheap borrowing encourages investment, supports employment, and prevents deflation. But low rates also produce another effect. Debt becomes normalized at an entirely new scale. Corporations borrow heavily to finance stock buybacks. Governments expand deficits. Investors chase higher returns through increasingly speculative assets. And households, still financially wounded from the housing collapse, slowly re-enter the credit system because they often have no alternative. This is where the modern American debt landscape truly takes shape, not through one dramatic policy, but through permanent financial accommodation. Money becomes cheap, assets become expensive, and ordinary life becomes increasingly difficult to afford without leverage. Housing prices recover rapidly after the crash, but wages do not recover at the same pace. Institutional landlords purchase enormous amounts of residential property. The average American family now faces a brutal equation. To avoid debt, they must often postpone participation in modern economic life itself. Homeownership requires mortgages stretching across decades. Reliable transportation requires auto loans lasting 7 years. Higher education requires long-term repayment obligations. And the system encourages this behavior relentlessly. Because modern finance no longer merely reacts to consumer demand, it manufactures demand by engineering affordability illusions. A $1,000 phone costs just $39 per month. A $70,000 truck becomes only $600 monthly. The system reframes price into psychological fragments. This is the critical mechanism. Debt changes the perception of value. Imagine drawing the process on a whiteboard. At the top sits the consumer. Every lender competes for small slices of that monthly stream. Mortgage lenders, auto lenders, and student loans all extract their portions. The danger is not always immediate bankruptcy. The danger is reduced resilience, one medical emergency, one layoff, and the system begins tightening like a vice. For millions of Americans, the catalyst is the COVID-19 pandemic. In early 2020, the global economy suddenly freezes, businesses shut down, employment collapses. For a brief moment, consumer debt stress actually declines. Savings rates spike because mobility and consumption decrease simultaneously. Yet underneath the surface, the structural vulnerabilities remain untouched. And once the economy reopens, they return with even greater intensity. Inflation surges to levels not seen in decades: food, rent, energy. At precisely the moment borrowing costs begin rising again. This creates the modern debt squeeze. Credit card APRs soar. Auto financing costs jump. The same economy built on easy borrowing now punishes borrowers. Look closely at today's financial landscape. Buy now, pay later platforms fragment purchases into invisible installments. Fintech apps gamify investing while extending credit access. American consumers effectively become income-producing assets inside a vast international financial machine. Their debt payments sustain retirement systems and bond markets around the world. Millennials and Gen Z enter adulthood facing elevated housing costs and expensive education. They normalize perpetual indebtedness because they have rarely experienced an alternative. The personal debt crisis is therefore both individual and structural simultaneously. Focusing only on personal responsibility ignores the machine reshaping incentives. The declined card at a Walmart checkout is not just a personal moment. It is a system signal. America's crisis is about an economic model. The system overestimated the long-term consequences of building an economy where millions must continuously borrow simply to remain participants inside it.